Hello everyone, welcome back. Today we are talking about chapter 9, operating cash flow. This chapter is very unique. We do not go deep into the theory and can start right off with the exercise. But first, I want to show you guys some key points and formula that you guys may need to focus on during this video. Firstly is operating cash flow. And the formula to calculate operating cash flow is EBIT minus the tax rate times the EBIT, and then plus the depreciation or amortization. What is EBIT? So EBIT stands for earnings before interest and tax. Because every company, as soon as they make the money, they have to pay the interest back to the creditor and they have to pay the tax to the government. DOA is depreciation or amortization. From the company perspective, you often have a lot of assets. For example, buildings, vehicles, plants, and so on. And this type of asset have a depreciation because it depreciates in the value through years. Finally, EBIT minus tax rate times EBIT. We can also call this one net income. So this is actually the formula for net income. So in other way, operating cash flow is equal to net income plus depreciation or amortization. Moving on to the second formula is the net salvage value. Net salvage value is equal to the salvage value minus the salvage value minus book value times the tax rate. So what is salvage value? Normally, an asset I will call is A has an initial cost of 1 million. And this will be depreciated in 5 years with declining balance method. So declining balance method means that every year this equipment, this asset A will depreciate at the same amount of money in 5 years time. So 5 years time. What do I mean by depreciate by the same amount of money? So $1 million divided by 5 years equal to $200,000. So every year, this asset A will depreciate for $200,000 until the last year, which is year number 5. And it will become zero. Because as I have just explained, an asset will be depreciated in the value through years. So specifically, here we use the declining balance method. Secondly, at the end of the period, there could be two scenarios. Either you will throw the asset away because it's fully depreciated and there is no point in keeping it. Either you are lucky and you are a very good owner. Your asset will still be used, it's still usable. So you can actually sell off it for a little bit amount of money. So in the case of selling off this asset, the money you make is the salvage value. We call it salvage value. The money you can sell the asset at the end of the depreciation. And one more keynote here is the book value. As we can see, there are 5 years. Year 1, Year 2, Year 3, Year 4, and Year 5. How do we determine the book value? So the same example, I have said that at the beginning of the period, we purchased the asset A for $1 million. So at the current time, which is year 0, the book value will be 1 million. After 1 year, we move on to year 1. The asset depreciate for 200k, because I have said that we use the declining balance method. Every year, the asset will be depreciated for $200,000. Therefore, the book value will become 1 million minus 200k, and it will become 800k. And the same thing happened in year 2, it becomes 600k. Year 3, 400k. Year number 4, 200k. Finally, at the end of the period, fully depreciate, and the book value, it will become 0k. Hopefully this explanation can help you guys easily understand what is the book value. Moving on to the next big thing is the change in net working capital. So what is net working capital actually? It's equal to the current assets minus the current liabilities. It's the difference, right? It's the difference between a company current assets and the current liabilities, as the formula shown on the screen. So it is used to measure a company's short-term liquidity, and the ability to cover its short-term obligations. So technically, the net working capital want to tell us how much money do we have right now in the company to work with. So now we already know what is the definition of net working capital. We can easily understand what is the change in the net working capital. The change in the net working capital is the difference between the net working capital of the current year and the last year. So for example, in year number 1, you have a net working capital of $20,000. Let's say minus $20,000. You invest minus $20,000. And then in year 2, you invest another minus $60,000 for a project. So the change in the net working capital, which is denoted by the delta sign of NWC, gonna be equal to minus 60k minus 20k. And the difference is minus 40k. One more thing we need to take note about net working capital. The first thing is that at the beginning of the period, at the beginning of the project, the net working capital is often a negative number. And at the end of the project, net working capital is often recovered. And what do I mean by recovery? The reason why the net working capital is recovered at the end of the period, because during the project operation, a company needs to invest in working capital to support day-to-day operations. Therefore, at the beginning of the project, we have a negative number. But toward the end, once the project ends or the investment period is over, we can sell off, for example, the equipment that we purchased at the beginning. Furthermore, these working capital requirements typically decline. Therefore, the net working capital is often recovered at the end of the period, the end of the project. And to understand it more, we're gonna do the exercise soon together. Exercise. Company AA is considering a new 3-year expansion project that requires an initial fixed asset investment of $3 million. The fixed asset will be depreciated straight line to zero over 3 years tax life, after which time it will be worthless. The project is estimated to generate $1.7 million in annual sales, with cost of $65,000. If the tax rate is 20%, what is the OCF for this project? We can clearly see that every number in this exercise is stated annually, which means that we are actually trying to find the operating cash flow per year, annually. Just for reference, you can always go back to the first slide to see the formula for the operating cash flow. So to compute it, first we need to find the EBIT, the earning before income tax. And how to find the earning before income tax? So we simply take the sales revenue minus the cost minus the depreciation which is going to give us the EBIT. And then we minus the EBIT times the tax rate, which will give us the net income. Finally, taking the net income plus the depreciation, and it's gonna give us the final answer of the operating cash flow. So here's the step-by-step in order for us to achieve this exercise. So now let's find the number. So firstly, we can see that the estimated sales revenue of the project per year annually is $1.7 million. So we put 1.7 here, 1.7 million. How about the cost? The cost is $65,000. And $65,000 gonna be equal to $0.065 million. Minus depreciation. Where's the depreciation? Well, of course, the exercise not gonna give us what is the depreciation. It only provides the clue. And the clue here is $3 million with straight line to zero in 3-year tax life. So I have explained before, this project has the initial fixed asset investment of $3 million. We purchased the asset for $3 million. And it had 3-year life. Therefore, the depreciation will be equal to the initial cost, which is 3 million, divided by the tax life of 3 years, and it will be equal to $1 million. So every year, the asset will be depreciated for 1 million. Therefore, the earning before interest and tax is going to be 0.635 million. Minus the EBIT times the tax rate, which is 0.635, we just found it, times the tax rate. So what is the tax rate? Oh, it's 20%. So 20%. So the net income will be equal to 0.508. And we plus the depreciation back to the net income, which is 1 million. We also just found it over here. So 0.508 plus 1 will be equal to 1.508 million. So in conclusion, the operating cash flow for the project is 1.508 million per year. Following previous exercise, suppose the project requires an initial investment in net working capital of $20,000, and the fixed asset will have a market value of $100,000 at the end of the project. What is the project year 0 net cash flow? Year 1, year 2, year 3. Suppose the required return on this project is 12%. What is the project's NPV? For this exercise, to find out what is the NPV of the project, we have to find the cash flow per year, through year. Therefore, they ask us what is the net cash flow in year 0, year 1, year 2, and year 3. In finance terms, we call this cash flow from asset, which is denoted by CFFA. CFFA is equal to net income plus depreciation or amortization plus equipment cost plus the change in the net working capital plus the net salvage value. Again, in order to achieve this exercise, we need to create a table. This is the table that I have constructed. Let's do it together. So in year 0, what do we have in year 0? Definitely not net income, not depreciation or amortization, not net salvage value, because the project not even started yet. But we do have the cost and the net working capital. Remember, the cost here is the equipment cost. It differentiates between the cost for revenue, cost of revenue. So looking at the previous question, you can see a line where they say that the project is estimated to generate 1.7 million in annual sale with cost of $65,000. This one is the cost of revenue. It's different from the cost we are talking about. The cost that we are talking about is actually this one, $3 million. It's the initial fixed asset investment. It's the equipment cost. Therefore here, the cost is going to be equivalent to minus $3 million, which is the initial investment to buy the asset. Net working capital, it requires an initial investment in net working capital of $20,000. This is a cash outflow. As I have explained, at the beginning, the change in the net working capital is always minus, always a negative number. Therefore, we have minus 20K, which is also equal to minus $0.02 million. So minus $3 million plus minus 0.02 gonna give us minus $3.02 million. So the cash flow from asset at the current year is minus 3.02. Moving on to year number 1. We start to generate income, just like the previous question that I have shown you guys. The net income is 0.508, and we have found it in the answer of the previous question. So net income is 0.508. How about the depreciation? Yes, we start to have depreciation since year number 1, which is $1 million. So plus 1. We don't have any cost. We also don't have any change in the net working capital, because this project only requires an initial net working capital investment at the beginning, the current year 0. Net salvage value? No. Net salvage value only occurs at the end of the period, which is year number 3. So, in general, in year 1, we have $1.508 million cash flow. And the same thing gonna happen in year 2. We will also have $1.508 million. Finally is year number 3. Year number 3, we also have the net income of 0.508. The depreciation is also $1 million. And as I have explained before, the net working capital, the change in the net working capital is often recovered at the end. So now we have plus 0.02. This is what I mean by saying recovery. 0.02, which equal to $20,000, will be added back to the change in the net working capital. And the net salvage value. The net salvage value is equal to $0.08 million. How do I know it's $0.08 million? Because they say that the fixed asset will have a market value of $100,000 at the end of the project, which is equal to $0.1 million. Then I also know that the book value is 0 at the end, because straight line method, depreciation. Next, we also know that the tax rate is 20%. Please refer to the previous question. Therefore, I can compute it, and it is equal to $0.08 million. So adding up everything gives me the final answer of 1.608. This is the cash flow from asset in year number 3. Let's find out the NPV together. Press CF to activate cash flow function. CFO will be 3.02 minus 3.02. Enter, go down. Cash flow number 1 is 1.508. Enter, go down. And we can see that in year 1 and year 2, we have the same amount of cash flow. So the frequency will be 2. Enter, go down. Cash flow number 2 is 1.608. Enter, and then we go down. The frequency is 1, so 1, enter. And the next step is to press NPV. They ask what is the interest rate. The required return is 12%. Here we can see, suppose the required return on this project is 12%. So 12, enter. Then we press go down, CPT, and the NPV is equal to 0.6731 million dollars. That's how we do this exercise. So the NPV is equal to 0.6731 million dollars, step by steps. This is also the end of the video today. Thank you guys for watching. You can always go back to the previous slide to see what we have been through today together. Thank you very much.